The date is January 6, 2026, a Tuesday morning in Lower Manhattan that began like any other, with the cold winter sun reflecting off the glass canyons of Wall Street and high-frequency trading algorithms humming in the background. But as the opening bell approached, a singular document hit the institutional wires, a report that has effectively frozen the financial establishment in its tracks. The document, released by Bank of America, is not a standard quarterly earnings forecast or a mild adjustment of interest rate expectations. It is titled The Price Fracture Report, and its contents are currently sending shockwaves through the fiber optic nervous system of the global economy. The report serves as a formal declaration that the silver market, currently consolidating in the high $70 range, is mathematically primed for a vertical ascent that defies conventional market wisdom. Bank of America, the second largest banking institution in the United States, has officially pinned a price target on the white metal that many would call an impossibility, yet their analysts describe it as an inevitability: $309 per ounce. This is not a prediction based on speculation or hope. It is a calculation based on the breakdown of historical market physics. To understand the gravity of this Tuesday morning, we must look past the ticker tape and into the machinery that drives asset valuations. For decades, the financial world has operated under a specific set of assumptions regarding the relationship between gold, silver, and the US dollar. Today, Bank of America's head of metals research, Michael Whitmer, has effectively signaled that those assumptions are obsolete. The bank is arguing that we are witnessing a structural revaluation, a fracture in the suppression of tangible assets that has held prices down for nearly half a century. The catalyst is not a war, nor a new pandemic, but a simple, ruthless reversion to the mean involving the gold-to-silver ratio. As the trading session unfolds, the price of silver sits at $78.84. To the uninitiated retail investor, this price already seems high compared to the lows of the early 2020s. However, the institutional eye sees something entirely different. They see a coiled spring compressed to the point of structural failure. The core of the Bank of America thesis rests on the gold-to-silver ratio, a metric that has served as the heartbeat of monetary history for thousands of years. As of this morning, that ratio sits near 59.1. In simple terms, it takes 59 ounces of silver to purchase a single ounce of gold. According to the Price Fracture Report, this number represents a gross miscalculation of value that the market is about to violently correct. Whitmer's team points to the historical precedents that govern these cycles. In 2011, during the last major liquidity crisis and metals bull run, this ratio compressed to 32.1. If the market were to simply repeat that mechanical adjustment today, with gold holding its current elevated valuation, silver would instantaneously reprice to $135 per ounce. That alone would be a historic move. But the bank's analysis goes deeper, venturing into what they term a black swan reversion. They are looking at the data from 1980, a year defined by runaway inflation and a complete loss of faith in fiat currency. During that mania, the ratio collapsed to 14:1. Bank of America has run the simulations for the 2026 economic landscape, a landscape defined by sovereign debt crises, central bank digital currency skepticism, and stubborn inflation. Their conclusion is that the conditions today are far more potent than they were in 1980. If the ratio snaps back to 14.1, which the report argues is the natural equilibrium for a scarcity-driven market, silver does not stop at $135. It catapults to $309. This figure, $309, is the number that is flashing across screens at hedge funds and family offices from London to Tokyo. It reframes the current price of $70–80 not as a peak, but as a deep value entry point, a generational discount available for a window of time that is rapidly closing.
The psychological impact of a major mainstream bank validating a triple-digit silver price cannot be overstated. For years, price targets of this magnitude were the domain of fringe newsletter writers and internet theorists. Now it is stamped with the seal of Bank of America. This grants permission for institutional capital to enter the trade. The report explicitly tells clients that looking at the nominal price is a mistake. The only metric that matters is the purchasing power of the metal relative to gold and the dollar. As the clock ticks past 10:30 a.m., the realization is setting in. A move from 59.1 to 14.1 is not just a trade. It is a historic wealth transfer from paper assets to hard assets. However, the ratio is only the first pillar of this explosive thesis. The second, and perhaps more terrifying aspect of the report, concerns the liquidity gap. This is the section of the document that is likely causing portfolio managers to sweat in their bespoke suits. Bank of America highlights a massive disparity in global capital allocation. Despite the price gains of recent years, the professional investment world is dangerously underinvested in precious metals. The data reveals that high net worth entities, pension funds, and endowments currently hold a mere 0.5% of their total assets in gold and silver. This 0.5% statistic is the smoking gun. It implies that the entire rally to $78 has been driven by retail investors, central banks, and early adopters. The smart money, the trillions of dollars managed by institutional giants, has effectively been sitting on the sidelines. But the economic climate of 2026, characterized by the weaponization of the dollar and the erosion of faith in sovereign bonds, has forced a change in strategy. Michael Whitmer's team has run portfolio optimization models which suggest that to hedge against current risks, a portfolio requires a 20% to 30% allocation to precious metals. The chasm between the current 0.5% reality and the recommended 20% necessity is where the price fracture occurs. This represents a wall of money, likely totaling in the trillions, that must try to squeeze into a market that is physically tiny. The silver market is notoriously illiquid compared to the ocean of treasury bonds or the S&P 500. If these institutions decide to move their allocation from 0.5% to just 1%, a tiny fraction of their capital, it would effectively double the demand for investment-grade bullion overnight. The problem, as the report starkly outlines, is that the physical metal simply does not exist to satisfy such an order. When a sovereign wealth fund or a pension giant moves capital, they do not buy a few thousand ounces. They buy entire vaults. They buy future production straight from the mines. The mathematical impossibility of fulfilling even a small shift in global allocation implies that the price has no choice but to rise to balance the market. At $78, there is not enough silver value to absorb the incoming capital. At $309, the market capitalization of silver expands enough to accommodate these institutional flows. Therefore, the price explosion is not merely a result of speculation, it is a mechanical necessity. The price must rise to triple digits to prevent a complete delivery default on global exchanges. This brings us to the third and most critical pillar of the Bank of America warning: the physical reality of the ground beneath our feet. We are currently in the fifth consecutive year of a structural silver deficit. This is a point that the mainstream financial press has largely ignored until now. The deficit is not a temporary supply chain glitch caused by a strike or a shipping delay. It is a deep geological shortfall. The report details a mining sector that is in a state of managed decline. Production from the major North American miners is forecast to drop by another 2% this year, despite the incentive of higher prices. Basic economic theory dictates that when prices rise, supply should increase. If the price of a widget goes up, factories build more widgets. But you cannot simply build more silver. You have to find it, permit it, and dig it out of the crust of the earth. The report highlights that we have reached peak silver in terms of easy extraction. The mines are deeper, the ore grades are lower, and the regulatory hurdles are higher. But the real killer for supply is the AISC, all-in sustaining costs. Inflation has not just hit the consumer at the grocery store, it has ravaged the mining industry. The cost of diesel, cyanide, steel, and specialized labor has skyrocketed. The report notes that for many operations, the cost to pull an ounce of metal out of the ground has doubled in the last cycle. This creates a hard floor under the price. Miners simply cannot afford to sell into a dip. But more importantly, it means that new projects are not coming online fast enough to meet demand. It takes 10 to 15 years to bring a new mine from discovery to production. This lag time means that even if silver hits $309 tomorrow, there will be no flood of new supply until the mid-2030s. The supply is inelastic. On the other side of this equation is demand, which has become ravenous. The year 2026 marks a point of no return for the green energy transition. The industrial consumption of silver has decoupled from general economic growth and is now tied to strategic mandates. Silver is the most conductive element known to man. It is non-negotiable for the production of high-efficiency solar panels, electric vehicles, and the advanced chips that power the artificial intelligence boom. Bank of America notes that industrial users are not price-sensitive in the same way investors are. An electric vehicle manufacturer must buy silver to build their car, whether the price is $70 or $300. It is a tiny fraction of the total cost of the vehicle, but without it, the vehicle does not run. This creates a scenario where industrial giants like Tesla, Samsung, and massive solar conglomerates are competing directly with monetary investors for the same shrinking pile of 1,000-ounce bars. The price fracture report warns that we are approaching a moment where vaults will be drained to satisfy industrial hunger. leaving nothing for the investment market. This is the definition of a supply squeeze. When the wall of money from the institutional world meets the empty vault of the physical world, the result is a vertical repricing event. The implications of this extend far beyond the commodities pits in Chicago or London. This is a macroeconomic signal regarding the health of the fiat currency system. Silver has historically acted as a barometer for the trustworthiness of the state's money. A move to $309 is effectively a vote of no confidence in the US dollar's ability to retain purchasing power. It aligns with the broader trend we are seeing in 2026, where central banks globally are dumping treasuries to buy gold, and retail investors are flocking to Bitcoin and stablecoins to escape the debasement of their wages. Bank of America's analysis touches on this symbiotic relationship between crypto and precious metals. In previous years, analysts viewed them as competitors. Now the report views them as allies in the same war against liquidity expansion. However, while Bitcoin captures the digital zeitgeist, silver remains the critical industrial component of the physical economy. You cannot build the hardware that runs the blockchain without silver. This dual demand, monetary and industrial, provides silver with a unique floor that purely financial assets lack. As the trading day progresses on this Tuesday in January, the volume on the silver futures market is beginning to spike. The algorithms are digesting the data. The realization is spreading that the $78 level was a gift. The report has effectively drawn a line in the sand. It argues that the downside risk is mathematically limited by the cost of production and industrial necessity, while the upside potential is multiples of the current price. It is an asymmetric trade of the highest order. Michael Whitmer and his team are essentially screaming a warning to their clients. The window to front-run the crowd is closing. The 0.5% crowd, the pension funds and insurance giants are waking up. When they move like an ocean liner, slow to start but impossible to stop. Once they begin the rotation into tangible assets to meet that 20% optimization target, the available float of silver will evaporate. We are looking at a market where the paper price has been suppressed for so long that the physical reality has finally broken the containment mechanism. The term reversion to the mean sounds academic and dry, but in financial markets it is often violent and swift. It is the snapping of a rubber band that has been stretched too far. For 46 years, since the Hunt brothers cornered the market in 1980, silver has languished below its inflation-adjusted all-time high. The Bank of America report suggests that the suppression requires energy, capital energy, to maintain. And the short sellers, the bullion banks that have historically capped the price, are running out of energy and running out of metal. Investors watching the charts today are witnessing the early stages of a breakout that has been building for a generation. The $309 target is not a random number picked from the air. It is the price required to balance the books of the global economy. It is the price required to incentivize miners to explore the dangerous depths of the earth. It is the price required to convince hoarders to part with their stacks. What makes this Tuesday, January 6, 2026 so pivotal is the source of the message. If this were a blog post from a gold bug, it would be ignored. Coming from the second largest bank in the United States, it is a paradigm shift. It legitimizes the thesis that the dollar is failing as a store of value and that tangible assets are the only lifeboat. The narrative has shifted from if silver will break out to how high and how fast. As the sun sets over the Hudson River, casting long shadows over the financial district, the mood has shifted from anxiety to urgency. The price fracture report is being forwarded, printed, and dissected in boardrooms across the world. The consensus is forming that the era of cheap silver is over. The dynamics of 1980 have returned, but with the added velocity of modern algorithmic trading and a global sovereign debt crisis. The move to $309 will likely not happen in a straight line. There will be volatility, there will be shakeouts. But the fundamental trajectory has been set by the laws of supply and demand, which cannot be suspended forever. The deficit is real, the institutional underinvestment is real, and the devaluation of the currency is real. For the individual investor, the message is clear. The opportunity to acquire silver at double-digit prices is a historical anomaly that is being corrected in real time. The train is leaving the station, fueled by a liquidity crisis and a shortage of physical metal. Bank of America has sounded the alarm. The question remains, is the world listening? As the digital numbers on the screen flicker and climb, it appears the answer is a resounding yes. The race for physical ounces has begun, and the finish line is set at $309.